Good morning, good afternoon, and good evening from whichever location you are watching me from. My name is Dunzo of Dunzo Lore Accountancy Tutorial. Today I will be taking you through the subject of taxation and in particular UK income tax. UK income tax. I will encourage us to get accustomed to some buzzwords that we might be applying while carrying out the computation. Things like taxable income, what are they? Adjusted net income, what are they? And so on. Grossing up, for instance, the donations we've paid net, you have to gross them up. So take note of those. Tax is a bit difficult for some people who have no tax background due to its intricacies. But if we follow it methodically and logically in simple way, it will be easy for us to follow. And then that will make us get interested in taking tax as a subject. Tax itself is a compulsory levy on income or earned by individual, okay, or self-employed individual or pensioners. So this is a compulsory tax on all individuals, okay, and then they will cover things like wages and salary, profit from self-employment, pensions, rental income, dividend from shares, and so on. All right. So these are the areas of income that could be taxed. This list again explain more about things on which you will pay tax. Look at them properly and get used to them. Having said, some items are not taxed. For instance, the first 1,000 of income from self-employment, this is trading allowance. The first 1,000 of income from property you rent, unless you are using the rent a room scheme. Income from tax exempt account like ISA, that's individuals savings account, and national certificates, savings certificates are not taxed. Dividend from company share under your dividend allowance, okay, some of them are not taxed. Some state pension benefit are not taxed, okay, some are taxable. Premium bonds or national lottery wins are not taxed. Rent you get from a lodger in your house that's below the rent a room scheme are not taxed. Get used to this list is not exhaustive, okay, but shows example of what are not taxed. Now, having gathered your income as an individual, you are entitled to a personal allowance, okay, which is stated in the statutory bulletin. For instance, for tax year 26-27, we start for 6th April 2026. UK income tax start from 6th of April and end the 5th of April. So for the tax year 26-27, this is personal allowance for everybody, 12,570. For example, if we look at three individuals, say A, B, C, earning the following income, 12,000, 12,570, 14,750. Having deducted their same personal allowance, they all have the same entitled 12,570. The difference is what to be taxed. So, for A, 0 will be taxed. We don't tax negative amount figures. B again, 0 will be taxed. But C, because his income exceeds his personal allowance by 2,180, so that figure becomes the taxable income. All right. If you earn above 100,000, this personal allowance will be reduced, okay, by £1 for every £2 that your income, okay, adjusted net income in this case exceeds 100,000. All right. So, what's the adjusted net income? Adjusted net income itself is total income less the following items. Once you deduct all these items from your total taxable income, you will have adjusted net income. Right. Now, so this is how it actually works. So if, for argument's sake, your adjusted net income is 115,000, okay, so you exceed the limit by 15,000. Divide that limit excess by 2 to get 7,500. this is knocked off your personal allowance of 12,570, so your allowance is reduced to 5,070. Okay. The following person are liable to tax. These are the people who will pay UK income tax. UK residents and non-UK residents. UK residents will pay tax on all their worldwide income. That's UK income plus overseas income. Whereas non-residents only pay tax on income that arises in UK, such as UK employment income, UK rental income, UK business profit. Employees and self-employed individuals will also pay income on their tax on their income. But for employee, it's simple. They follow the PAYE system, and the tax is deducted automatically from their earnings, which is done maybe weekly, monthly, or whatever. Only self-employed individual will now file their self-assessment. All right. The due dates for tax. The due date for tax. For individual or for employee, there's no problem. It's automatic, deducted by employer using the PAYE system. It is the self-employed individual that will now have to file their own income and self-assessment on the following date. 31st October, if they are filing the paper tax return. 31st January, if they are doing it online. Now, how you pay your tax will now follow. For instance, for we mentioned in the employee, no problem. It is self-employed individual on filing their online on 31st January. Okay, on 31st January, they will now pay the final bill for the previous tax year, because tax is paid in two chunks. 31st January, they pay the final bill for the previous year, and they pay the first payment on account for this year. 31st July, they will now pay the second payment on account for this year. Look at this example, go through them. There is a pro forma for tax computation, which makes it easy. If you follow this pro forma, you have no problem, because it helps us allocate allowance at the right item and apply the right rate, the correct rate for each item. So we have, apart from the items here, we have 4 columns: total column, other column, savings column, and then dividend column. So the first items here, trading income, employment income, and property income, all come under the other column. Okay, they come under the other column. Or this item, these 3 items here, they come under the other column. Make sure you do that. Savings, which is like interest on your savings, will come under savings column, and dividend you earn from the company you hold their shares will come under dividend column. Then once I haven't done that, you now total all the columns. The first total column will let you know whether your level of income, whether you are basic rate taxpayer, higher rate taxpayer, or additional rate taxpayer. Once you get that, you now deduct the relevant relief. You do the relevant relief, then that leads you to the net income taxable. After net income, it's after the net income you now deduct your personal allowance to get your taxable income. Follow this system and follow the pro forma logically, and you will not go wrong. The rates and bands you need is stated here. For example, the tax year 23-24, this is the rate. Personal allowance is up to 12,570, 0 rate. Basic rate tax from 12,571 to 50,270, 20%. Higher rates from 50,271 to 125,140, 40%. And any other thing above 125,140 is taxed at 45%. Let's look at an example to help us with this particular tax computation. Now, let's let's take an employee scenario, gross salary of 50,000. So as you can see, this is below the basic rate band. So we have no, though there's a pension of 3,000, there have no issue with that because the whole income is within the basic rate band. So they will attract only 20% tax. The idea of the extending the basic rate band by the gross amount of the donation is to ensure that they attract tax at only 20%, so they don't get caught in the 40% band. All right. So for here, the tax is 0% for 12,570. Tax is 0, and the, above that, which is 24,860, at 20%, 4,972. That is tax on this. Going to the next, advancing to 80%, 80,000. Sorry. This is to push us above the basic rate band, so that we can now extend the basic rate band here by the gross amount of donation, which is 5,000 divided by 8.8, which is 625. That is what gave us the 56,520. So between 12,570 and 56,520, the difference is 43,950. This is one that starts at 20%. Okay, we know that below that, which is 12,570, is 0. So the next band is now from the remaining chunk of the taxable income, 23,470. This attract tax at 40%, and that's why you have the 9,392 to give total tax payable of 18,182 pound. 18,182 pound. So that's how we do it. Okay. Well, no, with tax, as basically we tax 43,950. So from 43,950 to the balance of taxable income of 67,430, that gives us this difference. This is how you do it. Be careful. Now let's move on to a higher figure of 125,000. Here again, we're going to do because it's now above the 100,000 limit. So the total tax payable is 125,000. So we do the working to get what our allowance is reduced to. So 125 less the gross amount of donation, which is 6,000. That's 6,000 divided by 8. 6,000 divided by 0.8 gives 7,500. That's the figure here, gross donation. Deduct it from the 125,000 to give us adjusted net income, ANI, adjusted net income, which is 117,500. So this deduct the 100,000 limit, the difference is 17,500. Divide this by 2, the deduction amount is 8,750. 8,750. Knock this off from the personal allowance of 12,570. The personal allowance becomes 3,820. That's personal allowance here, 3,820. That's a working one. That's a working one. How you got the figure here? So again, we carry on again. 0 to 12,570, 0%, 0. 12,570, extending the basic rate by the difference of 7,500, extending the basic rate to that. That goes 57,770. So the difference is 45,200. At 20%, tax is 9,040. All right, 9,040. So now between 45,200 and the taxable income of 121,180, which is here, give us a value of 75,980. At 40%, give us tax amount of 30,392. So total tax payable is 39,432. I will be introducing more items like dividends, interest in our next session, so that I kept it this simple just to make sure that we don't get overwhelmed with figures and then rates and allowances. So go to this, enjoy it, and then see how conversant you can be with it. Go to yourself and then get used to it properly. As I said, I will introduce more items like interest and dividend in our next session. I hope you've enjoyed this particular session. I try to make it as simple as possible. If you enjoyed it, please give us a like, and please do subscribe, give us a like, and do share with your colleagues so that more people will get you into income tax computation and then take it further as a career. Thank you for watching. Bye for now.